Hello and welcome to the Mutual Fund Show. Over the next 25-30 minutes, we'll talk all about mutual funds. And this show, of course, aims to bring you advice from industry experts so that you can make smart choices in your MF investment journey. Yesterday, some PSU stocks dragged the Nifty PSU Bank Index in the red. Defense stocks were in the red. And overall, the PSU performance was looking wobbly. Can this performance be used as a lesson when it comes to investing in PSU funds through mutual fund route? Have these funds corrected enough for them to become a part of your portfolio? The answer is likely not, because there could be more in store. And I think that is what we'll try and talk to our experts today. On the show a bit later on, we'll get in Tarun, Birani and Ruchi Sankhe to talk about their thoughts. Tarun, of course, is the founder CEO of TBNG Capital Advisors. So that will be a conversation that you should look forward to as well, especially on the PSUs. And of course, also get in Ruchi Sankhe to talk about her thoughts. Just a quick update on the numbers that are flashing on your screen. Need to not forget that it's the bang in the midst of the earnings season, so we can't really take our eyes off the ball. There's West Coast paper that has come out with numbers wherein the net profit at 158 crores is nearly half of what they did in the corresponding quarter last year at 310. And therein lies the problem for West Coast. So about some bit of a correction. Even the revenue is about 15 to 20% lower, I believe. EBITDA down 52%, as I said, and as a result of which the stock is looking slightly weak. Remember, it's not a very thickly traded stock, so the volumes could be a bit suspect here and there. But per se, the numbers don't inspire too much of confidence. Net profit down about 48% or 49% at 158 crores, and revenues at 1,045 are about 15% lower. But while the Nifty is up and about, there are a few other stocks which have looked wobbly on the Nifty 500 or the BSE 500 list, and some which have looked strong. So, of course, the key culprit in today's session has to be Hindalco. Sharp pullback there, 14% lower even now for a Hindalco, 14.16, about 30 million shares traded post Novelis Capex announcement. So, that stock certainly in focus. You know, Paytm has dragged some of the tech names lower yet again. It's down about 10%. And I wonder what's happening to some of the tech funds. So I think we'll kind of talk about that as well with our experts, about whether some of those tech funds remain interesting to invest into or no at the current point of time. So that comes firmly in focus. There's some weakness today, I must say, in companies on the tech space by and large, because KPIT Tech, for example, is down about 6%. Remember, it's an expensive stock, so would correct at any given day significantly and shouldn't surprise anybody in terms of, because it is not necessarily only news flow which drags KPIT down. Profit booking could also be one of the reasons. But PSUs are having an iffy day yet again, because I saw SJVN earlier on in the day, and that stock was down about 6-7%, though some like IRFC are bouncing back as well. Let's try and understand what to do about this aspect. Our experts, Ruchi Sankhe and Tarun Birani, are with us on the show. Both of you, thanks so much for taking the time out and being with us on the Mutual Fund Show. Ruchi, I'll start off with you. What's your sense around some of these PSU funds or funds which have got a higher PSU weightage, because they've been the talk of town for the last 2 or 3 years? We are doing an analysis of how the PSU stock index has gained very splendidly over the last 3 years. For the first time, it is starting to see some bit of a corrective move. Is this move to be utilized to invest further into these funds, or would you stay away from these?
So I think you're absolutely right. PSU funds have seen a very good performance over the last 2-3 years. In fact, even if you look at the last 1 year, some of the PSU focused funds like Aditya Birla and ICICI have seen north of 50% returns on just a 1 year return basis. So at this point of time, with a lot of sort of return captured already by these funds, I would suggest it may be time to profit book and move out of these funds and really position your portfolios elsewhere. So at this point of time, my view is that let's profit book and move out of the PSU funds because of the strong returns that we've seen already in this space.
Okay. Tarun, what's your sense?
Yeah, hi. Good afternoon, Niraj.
Good afternoon.
And again, As usual, I'm a strong believer of suitability. I think suitability defines what needs to be done by the client, and there's a core and satellite approach. And core approach talks about strategic portfolio, which is there for long-term wealth creation of the client. But from a satellite perspective, is where you can look at tactical opportunities from time to time. We have seen the category which you are talking about, PSU. I think from last decade has been a underperforming category.
Tarun, I'm sorry, but
Look,
I've gotten your feed slightly patchy. I can't quite hear you, but I think the earlier part of his answer, wherein Tarun said that he's a strong believer of suitability, would possibly mean, and we'll wait for him to confirm this, of course, but could possibly mean that what he's indicating is that if portfolios are bent towards uh, possibility of taking a little bit of a risk, and a little bit of risk might enable the portfolio to have that desired alpha, and who knows, maybe some of these PSU funds at a right level might be a good idea as well. He is of course speaking about how PSU banks, for example, a lot of reasons and a lot of factors which will help the PSU banks going ahead, and some of the banking PSU bank index or otherwise might not be bad plays as well. He of course believes that there is significant exposure showing some positive signs to some key sectors, and regulatory support and reforms in banking are bolstering confidence. And viewers, if you see the last 5-year perspective of what the PSU banks have done versus how the private banks have done, you will get a sense of how the market kind of recognized it. And for funds which had a higher proportion of PSU banks in their portfolio, they would have done much better. Similarly, PSUs by and large, or having a larger PSU presence, would have meant quite significantly for some of the funds which would have either be PSU centric funds or would have had some PSU exposure. So I think you got to keep that at the back of your mind. Ruchi, I don't know if you are at a liberty to, or if you've looked at some of these PSU funds as well, but is there something that stands out? Is there some fund which by virtue of its past investment practices or the portfolio stands out versus the rest? Can you recommend that at all?
Uh, Actually, to tell you the truth, Niraj, while I did hear on the sector focus, we are definitely straight away from sector focus in my advisory practice, and I do not create a satellite portfolio that will be based on certain sectors. So my information to you was more broad based, but I have not looked at this PSU fund space so much in detail, and I wouldn't recommend thematic or sector funds to my clients. So. I'll have to sort of refrain from answering this question to you.
Fair call, fair call. Completely understand. But I mean, I'm glad you called it out, but I believe we have Tarun back. And Tarun, sorry, you were finishing your point. So can I ask you to finish your point around the PSU funds?
so Neeraj, is the question for me, right?
Yes, please.
Yeah, so Neeraj, sorry for the network issue. What I was talking about was suitability should define what needs to be there in the portfolio. And as I mentioned that if the client has suitability in terms of liquidity, in terms of taking higher risk, looking at sector specific fund, yes, they need to take it. Right. So from a suitability perspective, safety, stability, aspiration, these are the three metrics we look at. And I feel any high risk investment should come in the aspirational investment, which one can look at concentrated investing only if they have that kind of risk appetite. From a PSU sector in as such, if I look at last 10 year, a decade, this sector has not done well, and government is not considered as a great capital allocator, at least from a long term data if I look at. But last 2 3 years we are beginning to see a lot of macroeconomic changes, a lot of data is changing for us, inflation, interest rates, as well as we are seeing these PSU companies are allocating capital in a much efficient way. So that is one very big reason we start to see a lot of action happening in terms of their market cap performance also. So looking at that, investors who are ready to look at this story from a 5 to 10 year in their satellite portion of the portfolio can actually definitely look at this opportunity. But I would strongly recommend for anybody who don't understand this space to look at diversified fund, because a diversified fund manager always have a ability to buy any sector what he wants, right? So one can anyway participate there.
Okay, that's a fair call too. Now, this, the other piece is momentum funds which have been launched recently, and there are a few of them available in the mutual fund space, available in the small cap space, etc. We were looking at the HDFC mutual fund launch of the HDFC Nifty 200 Momentum 30 Index Fund. The larger question, and Tarun, this theme I'll start with you. The larger question: is it advisable to invest in momentum funds under the current market scenario? I don't know if you've looked at this NFO and whether you can recommend a yes or a no, but is it good vis-a-vis some of the other NFO, other funds on the momentum side that might be existing? What is your views?
So, Niraj, I can't talk specific to any fund, but what I can talk about is this index. And I think this index is a very popular index, which is form of top 200 stocks. And out of those 200 stocks, based on a Z score, and Z score basically calculates the momentum characteristics of a portfolio. Okay, so this Z score identified top 30 stocks. And the theory of momentum investing is what is doing well currently has a certificate of market, and it will continue to do well in future. So it is a kind of investing which looks at current opportunities and which market is favoring currently. If I look at last 20-year data, and there is a lot of data available in momentum investing index, and last 20 years this index, out of 17-year data, in 5 years it has underperformed Nifty. Otherwise all the other years it has outperformed Nifty by a good margin. My call is, if somebody is looking at a good large to mid cap mix in the portfolio, because this index will have 100 top 100 large cap stocks and top 100 mid cap stocks. So it is like a, I would say, large and mid cap index kind of index. And looking at aggressive investment portfolio, this could be a great addition in their portfolio. This index could be a great addition, but it should be taken with a 5-year horizon, because the rolling return data, if I look at from a 3-year and 5-year, there is a good 97% chances on a rolling return data that this index has outperformed Nifty by a good margin. So I think data is clearly favoring this index. But again, this index with a combination of a low volatility index could also be explored, because it can really smoothen out the investment journey for a client. So if that low volatility index as well as momentum is taken in the portfolio, this can really give a very good client experience from a 5-year point of view.
Okay. Ruchi, you have any thoughts on momentum investing via mutual fund route and this particular one?
Definitely do. Obviously you've seen that passive strategies have really taken, it's a different way of investing. So while we've had active managers, index funds have also now really gained a lot of traction. This strategy is also attracting a lot of flows, and it's good to have a passive investment strategy, like this is basically quant-based strategy also as part of your portfolio from a diversification standpoint. Now, if you were to talk about the HDFC NFO, again, I would say that there is a strategy which is similar, which was launched about 2 years ago by UTI. And obviously, you can see the track record and the history over there. And what's obvious is that when the markets are doing well, obviously this overperforms the market, but the drawdown is also higher when the markets are in a bearish phase. So it is a high risk, high return strategy. You may want to sort of consider that as a small allocation to the portfolio, because you want to, sort of diversify by different ways of strategies. But I would obviously take something which is tried and tested and already there in the market versus something that's getting launched newly, and be careful of the fact that it's not going to be just a one-way kind of return journey, because the drawdowns, when the market, it will see much higher volatility when the market is sort of in a bearish phase. So having said that, what my view would be, yes, add it. But definitely be careful of the risks associated with it, and look at a tested strategy rather than a new strategy that's getting launched. So those would be a nutshell what my view will be.
Got it, got it. No, fair call. And viewers, please understand, before we take that break though, just remember for almost every single NFO that comes out, the advice is pretty similar, that there are tried and tested strategies existing, whether this category or others, and maybe those might be better. But there's so many queries around NFOs that we are forced to ask our guests, but usually viewers, remember, if you don't get advice, most advice is tuned to that look at the tried and tested strategy, might be a great bet, performance is known, portfolios are known, and you can analyze it much better vis-a-vis maybe NFOs. Because there are a couple of queries that have come in, we'll try and start off with those and try and help two of some of our viewers today. The first one is Pankaj Pandey. He's aged 41 years. Tarun and Ruchi, I'd love for you to be able to help out if you can. He says that he's currently investing 50,000 rupees via SIPs in 8 to 10 different regular funds. Most of them are multi-cap or flexi-cap schemes. His question is, what should he do with the accumulated corpus? Should he keep it in regular mode or move it to a direct plan? Should he make additional investments to a direct plan, because now he probably knows which schemes he wants to invest in? What would your views be? Ruchi, I'll start off with you on this.
So as an advisor, I would never recommend anyone to invest in a regular plan. In the equity side, especially in the multi-cap and the flexi-cap side, the differences in the expense ratios can be as high as 1 to 1.5%. So you're losing that out of your annual return every year. Basically, you are losing that compounding effect as well. So definitely, all incremental investments need to go in the direct plan. And what he has already invested, he should look at least look at the exit costs. If it is less than a year, sometimes there are exit loads that are associated with it. So one would hold on to those investments and make sure that you cross that exit load, and also look at it from a tax perspective, and then switch it really to a direct plan is what my view would be. So that's in my nutshell. And also look at the portfolio and see that you've got, while you've got multi-caps and flexi-caps, index funds is a great fund, a way to invest in the large cap segment. If you don't have that, include some of those. Also, given the way the markets are today, most of the funds are all growth focused. So if you don't have a value exposure, then look at just adding some value funds as well. And I would just construct a robust portfolio, which will be more on the through a direct route.
Okay, Tarun, I presume that would be a fair deduction, with the presumption that he knows how to analyze mutual funds or has an advisor who's advising him, because else he might not know how to switch.
So, Niraj, I want to add one larger point, and I want to give a message to larger viewers on this point, that people tend to feel that mutual fund, they need to put 8 to 10 funds in their portfolio, 15 funds in their portfolio, always keep adding new strategies based on FOMO, sometime energy sector, sometime PSU sector, sometime this. According to me, it's a operationally nightmare, and it's a very big energy loss. A 3 to 4 good funds portfolio can take care of the job. Now he's talking about a 50,000 SIP. I think a good 2, 3 funds SIP, that's it. They don't need anything else. Mutual fund in itself is a very diversified portfolio, 50, 60 stocks. And if you start allocating it into 8 to 10 different funds, I don't feel benefits of diversification actually comes, and a lot of overlapping of stocks keeps happening. So to keep it from a long-term perspective, because operationally, if people keep adding new fund based on listening to experts like us, they will always keep adding new funds. And I feel after 3 years, 5 years, they will realize that actually it's not adding any value. Long term, the returns will keep coming, but operationally, it's a nightmare to manage such portfolio.
Fair call. Okay, we just have about 2 minutes left, so slightly shorter answers for the next query. Clinton Ashley Sullivan, 54 years. Interestingly, he's got some 5 funds and he puts 2,000 rupees per month in each fund. So therefore, the next fund will come, same fund will come for repetition only after 6 months, something like that, right? But ICICI Pru Sensex, ICICI Pru Balanced Advantage, HDFC Balanced Advantage, HDFC Mid Caps, and HDFC Focus 30. He wants to invest 10,000 rupees additionally. Asking about what are the funds that he can look at. We have about 40 seconds for each answer. Tarun, I'll start off with you. 40 seconds.
Yeah, so looking at the age, and I can see he's closer to retirement. He has a lot of balance advantage strategies in the portfolio. I don't have his risk tolerance and in terms of his return expectations and all that. But my suggestion would be in looking at the current market environment, large cap strategies, as well as asset allocation, dynamic multi-asset allocation strategies look best. That is where, and maybe the existing funds he should add. He should not try to add more funds.
Okay. Ruchi, what would your advice be?
I would actually concur with Tarun. More look at more large cap strategies and index funds. But I also concur with what he said earlier. That doesn't make sense in adding too many funds for for the quantum that he's looking at. So, but large cap and index could be good additions.
Hopefully all the viewers are listening to this. Thank you so much, Ruchi, as well as Tarun, for joining in today on the show and giving us your advice. Really appreciate your time. Viewers, thanks for tuning into this leg of the MF show.